Hello and welcome once again to a futures video. I have an example for you to help you understand how futures contracts work. On December 1st, an oil distributor strikes a deal with a client to deliver 420,000 gallons of heating oil on the 15th of each of the next 4 months, December 15th through March 15th of the next year. The selling price of the heating oil is agreed to, $2 per gallon. The oil distributor thinks that spot heating oil prices will fall over the next few months. Consequently, the oil distributor plans to buy the heating oil in the spot market on each delivery day just prior to making the delivery to his client. In this case, the downside risk for the oil distributor is increasing spot oil prices in the future because the selling price is fixed, but the heating oil is not yet owned. The oil distributor therefore hedges his purchase prices of spot heating oil with a 4-month strip of futures contracts. FC is the notation. By the way, the standardized size of a heating oil futures contract is 42,000 gallons. So on December 1st, the oil distributor goes long 10 January futures contracts, locking in a buy price of $1.90, and those will be used to hedge the December 15th delivery. The January futures contract will have its last trading day in late December. So the January contract is the best futures contract to use to hedge a 12/15 delivery. The oil distributor will also go long at the same time 10 February futures contracts where the price is $1.80 that he's locking in, and that'll be used to hedge the January 15th delivery. He'll also go long 10 March heating oil futures contracts, locking in a buy price of $1.70 to hedge the February 15th delivery. And he'll also go long 10 April heating oil futures contracts, locking in a price of $1.60, we assume, to hedge the March 15th delivery. And so this is the strip. He's buying a total of 40 futures contracts, 10 January, 10 February, 10 March, and 10 April. The prices he's locking in differ because these are the market prices at the time the purchase is made for these futures contracts on heating oil with different delivery months. Okay, so this is a 4-month strip of heating oil futures contracts, and all of these are purchased at the same time on December 1st. Now the oil distributor will have an operating profit or loss as well as a futures contract profit or loss each month. Okay? Now the operating profit on a per gallon basis will be the $2 price locked in minus whatever the spot price of heating oil is when he goes to buy it just prior to taking it to his client and delivering it. So on 12/15, his operating profit per gallon will be the $2 selling price minus whatever the spot price of heating oil is on December 15th that he has to pay. Now I'm using the word profit. Of course, it's not really profit. We haven't considered fixed costs, etc. So we'll just use the profit in a general lay term here. It's some sort of a contribution to fixed costs and profits, to be more precise. So that's the operating profit. $2 minus whatever the spot price or cash asset price is at the time of purchase in the spot market on the same day the delivery occurs, those dates here. Now, the futures contract profit on a per gallon basis for the December 15th delivery will be the price that's locked in, $1.90. So minus 190 plus the exit price of the January futures contract on December 15th. Now realize the oil distributor drives up to wherever he has to go to actually to pick up the heating oil. And at that time he pays whatever the spot price is for 420,000 gallons. And at that moment he's paid that spot price. So he has to remember to, at that same moment, to actually close his January futures contract position. Since he bought to open, he'll sell to close. So that's one thing we have to keep in mind, that the oil distributor will take a short position in January futures contracts immediately after he actually buys the 420,000 gallons of heating oil on December 15th, as well as January, February, and March 15th, of course. Okay, so the futures contract profit per gallon on December 15th will be minus the 190 locked in buy price, whatever the exit price of the January futures contract, because that is what he's really, if you think about it, he's actually, when he goes short these contracts, he's obligating himself to make delivery, and then here he's obligated to take delivery, and the difference in price would then be his profit. However, he's not holding the futures contracts into the delivery month, rather he's closing his positions. So that's why we say his futures contract profit is minus 190 plus whatever the exit price of the January futures contract is, because he's not going to make use of the delivery mechanism. He is not going to make use of that delivery mechanism. And the same with the January 15th delivery, which uses the February contract, the February futures contract, and the futures contract profit per gallon in February would be the price locked in, on January 15th using the February contract. The futures contract profit would be minus $1.80 plus whatever the exit price of the February futures contract is on January 15th, when he actually takes a short position in that. Okay, and March and April as indicated here. So the oil distributor has expected profits, ignoring basis risk, that look like this. On December 15th, 420,000 gallons times the selling price of $2 minus his locked-in buy price of $1.90, 10 cents a gallon on 420,000 gallons. His expected profit for the 12/15 delivery is $42,000. Again, it's obviously a contribution to fixed costs and profit, not really profit. We're just using a layman's interpretation of the word profit here for convenience. On January 15th, on that January 15th delivery, his expected profit will be 420,000 gallons times the locked-in selling price of $2 minus his locked-in buy price of $1.80 via the long position in 10 contracts, the February contracts. And so that's 20 cents a gallon times this 82,000 expected profit. For the February 15th delivery using the March contract, his expected profit is 420,000 gallons times $2 minus $1.70, 126,000. And using the April contract to hedge the 3/15 delivery, 420,000 gallons times the selling price of $2 minus the locked-in buy price of $1.60. That's 40 cents a gallon times 420,000 gallons. Expected profit of $168,000. Now these expected profits would be exact if the cash asset cost at that time, which is notation from above, but it indicates on the 15th of each month. So these would be exact. These expected profits would be exact if the cash asset cost on the 15th of every month equaled the exit price of the futures contract at that moment. However, cash prices and futures prices are not the same. There's a full carry model that may or may not be holding. So we say, but there's basis risk. Remember, the basis is just the cash price minus the futures price. It's the difference in those prices. And so if they're equal, then the expectations would be what the profits would be, but they're not likely to be equal. They could be, but they're not likely to be. Okay? So for example, perhaps the December 15th delivery would actually have profit data that looks like this. The operating profit might be the $2 selling price minus, let's say he had to pay $2.30 a gallon when he bought it, and he bought 420,000 gallons, so his operating profit would be minus $126,000, or a $126,000 operating loss. At the same time, his futures contract profit, we assume, will be this: his locked-in buy price of $1.90 plus the assumed price of the futures contract when he takes his 10 short positions in the January contract, so he effectively closes that position. So minus $1.90 plus $2.32 times 420,000 gallons, that's 42 cents profit, times this is a profit for the futures contract trades of $176,400, and when we net these two, we get a net profit of $50,400. Now keep in mind that's versus the $42,000 expected profit. So this is what could happen. Remember, risk is two-sided. There's upside risk and downside risk. We're generally concerned more with downside than upside, though. So note that here in this example, the basis on the delivery date of 12/15, that's the day the oil distributor delivers the oil, not the delivery date of the futures contract, just the date that he delivers the oil to his client. 12/15 is, of course, the basis is just basis equals cash price minus futures price, and the cash price value is $2.30 by assumption in this example up here, and the futures contract price at the time by assumption is $2.32. So the basis we assume up here is minus 2 cents. Now you can imagine that if this market were in backwardation and the futures price were much lower, keeping the cash price at $2.30, if the futures price was much lower, let's just say $2.25, just to choose a number, then this would be $2.25 here instead of $2.32, and that would be 7 cents less here, and so our profit would be, our futures contract profit will be 7 cents lower per gallon, which would significantly impact our number here. But as the example is shown, the basis is minus 2 cents. And that's all for this video. Thank you for watching.